Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at a requested stock, Jackson Financial Incorporated, ticker JXN. I don't really like to review finance stocks because there's such a different process and it's so complicated. But we'll at least take a look at the consistency and the dividend and things like that. And also, this is such a new stock to the market that I don't have a whole lot of data to work with either. So it does make things a little difficult to evaluate. It'll probably be a quicker video, but we'll get right into it and see what we can find. So I've set up this dashboard to give a summary of everything, and it's really giving us a bunch of junk because financial companies are very different. This debt to equity ratio is not actually 35.35. They have a lot on their balance sheet where they have funds coming in, and then there's funds that they owe. The balance sheet of a financial company is not like your traditional company. So that's not a piece of information that is really useful. Neither is the ROE. Dividend yield is useful. They're at a pretty high dividend yield right now, 6.53%, historical average of 3.76, payout ratio of 13.52. So they have a really high yield and they have a lot more room to grow that, which is good. And the actual growth of that is a lot. They've been doubling, tripling, quadrupling up on that dividend year over year. They didn't even start paying a dividend until more recently. So I actually just fixed this number. And this is all that we really have to go off of because the 2-year compound annual growth rate, they've only been paying a dividend for 2 years. So they have been doubling up on it year over year on average. And they've got some more room to continue with that, probably 2 or 3 more times. Cash flow, they're really strong on cash flow. Of course they are. Right now, their cash flow yield is actually a little bit lower than their historical average. Earnings are very strong. They need to come in with at least $1.90 to have a decent earnings yield. And well, last year they came in at $16.27. This year, $14.09 is expected. Next year, $16.05. So very, very strong on that front. And then net margins, 63.65, historically 17%. So things are looking there good as well. And we can just look at all these graphs and see how things break down. I'm not sure how useful the actual metrics here are. We do see consistent growth. We do see there's a huge hit to the revenue this year and a bit of a drop in the earnings per share. But we've seen that in a lot of companies, and it might just pose as an opportunity to buy. So financially, we're not seeing a whole lot of growth here. We saw a low 2019, stagnation from 2020 to 2022, and now it's dropping back down in 2023. So that's not a good graph. Gross profit, net profit, and EBITDA. There is no gross profit because it's a financial company. They do the financials a little different. EBITDA looks better in 2021 and 2022. Net profit, same story there. Not really enough to go off of. Inconsistency over a 2-year period. Balance sheet. Assets are pretty flat. Liabilities are on the decline. And the tangible book value is consistent. So that's flat as well. Cash flows, they're high. They're not really growing. In fact, they're kind of shrinking. The dividend, they did pay nothing. They've started to raise it. If they continue at this rate, things will be great. And then when everything's actually graphed out, of course, the balance sheet is crazy. It's not actually factored into our fair value here because of how insane it is. Same with the cash flows. We just put a very small portion of it because the calculation there is cash flow per share times 20 is typically a reasonable price for those cash flows. And well, with how high their cash flows are, you end up with a price in the thousands. So really all that we're looking at is down here, this cluster where earnings, the fair value, the actual value, and the dividend all place the stock. And it's somewhere between 20 and 65 this year, 30 and 72 next year. So there is growth. There is relative consistency. We're not seeing huge drop-offs, huge runs on anything. It's just the cash flows I'd like to see growing rather than shrinking or holding flat. And that's probably one of my main concerns here. If we take a look at the expenses as a portion of revenue, they've been good at dropping that. Last year, 20.4%. So they're getting a lot of that money from the top line to the bottom line. Yeah, last year, 9.7 top line, 7.8 bottom line, 63.6% margin, 16.27 EPS for a 46.8% earnings yield because the share price was $34.79. So it's got a very low PE, a very high dividend yield. It looks like there's some consistency going on into the future here. So it's a hold to a buy. There's probably a bit of risk here. It's new to the market. It's put on some, but some metrics like the revenues are showing a bit of a decrease. So we need to see how this stock actually fares in the market over time. Only given 2 years of data, it's very hard. I would say if you're risk adverse, it wouldn't be bad to hold. They have been able to turn things around from a negative operation to a very strong positive operation. Even if there was some declines to something along a 30% net margin, they'd be a decent company. So some exposure would not be bad here. I wouldn't go all in on it, especially considering that it's a financial stock and they're notoriously difficult stocks. But that's what we're seeing in this one. So hopefully you got what you needed out of this. It's just really hard to take a look at financial stocks like this and give a good valuation. All that we can really go off of is the consistency in some of these numbers here. And we see improvements and we see relative consistency. So I'd say it's better than some other options. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment if you hold any of this stock and subscribe so you can stay up to date with everything. And I'll catch you next time.